Welcome back to Boni's Life, your home for navigating the complexities of the financial world. Today, we're diving deep into the crypto market, dissecting the last 24 hours to forge a winning strategy for the next. The market is a battlefield of conflicting signals, and our mission is to cut through the noise, arming you with the intelligence you need to trade with confidence. Let's get started. The last 24 hours have been at a tightrope walk for Bitcoin, which is currently hovering around the $68,000 mark. While we've seen some minor gains, with Bitcoin up about 1.8%, the broader picture tells a story of caution. The crypto fear and greed index is flashing a score of 8, indicating extreme fear, and for good reason. Bitcoin is still down 2.5% for the week and has been in the red for 5 of the last 7 weeks. This isn't a market for the faint of heart, but it is a market of opportunity for the well-informed. The recent price action has been characterized by low volatility and tight ranges, which often precedes a significant move. The question on every trader's mind is, which way will it break? To answer that, we need to look at the confluence of fundamental, regulatory, and on-chain data. To understand where we're going, we must first understand the fundamental forces at play. The macroeconomic environment is a major headwind. The Federal Reserve is walking a tightrope of its own, with minutes from their January meeting revealing that several policymakers are still considering interest rate hikes to combat stubborn inflation. The latest core PCE price index, the Fed's preferred inflation gauge, came in at 3.0%, still a full percentage point above their 2% target. This, coupled with slowing GDP growth, creates a challenging environment for risk assets like crypto. As Yoni Asia, the CEO of eToro, recently stated while he predicts a rebound for AI stocks and crypto in 2026, he also acknowledges that monetary policy later this year will be a key factor. The market is pricing in the possibility of a more hawkish Fed, and that is casting a long shadow over the crypto space. The CME FedWatch tool is now showing a decreased probability of a rate cut in the near future, which is a significant shift in market sentiment from just a few weeks ago. However, it's not all doom and gloom. In fact, a potential sea change is underway in Washington, D.C. that could be a massive trigger for the crypto markets. The Clarity Act, a bill aimed at providing a clear regulatory framework for cryptocurrencies, is gaining momentum. Prediction markets now give it a 70% chance of passing, and Ripple CEO Brad Garlinghouse believes there's a 90% chance it will pass by April. As Shark Tank's Kevin O'Leary said, there are trillions of dollars waiting on the sidelines, but they can't move until it's regulated. This legislation could be the key to unlocking that capital. Venture capitalist Michael van der Popp echoed this sentiment, stating that the Clarity Act would be a massive trigger for the markets. The potential for a regulated and compliant crypto market in the US is a powerful narrative that could drive the next major bull run. The passage of this bill would provide the regulatory clarity that institutional investors have been waiting for, potentially leading to a flood of new capital into the market. Adding to this regulatory tailwind is a quiet but significant shift from the SEC. They've just updated their guidance to allow broker-dealers to apply a mere 2% haircut to their stablecoin holdings, down from a prohibitive 100%. This is a game changer for stablecoin adoption and signals a more accommodating stance from the regulator. It's a move that, according to some, has opened the door for wider institutional adoption. This is a crucial development, as it reduces the perceived risk for traditional financial institutions to engage with stablecoins, potentially leading to a significant increase in liquidity and adoption. This is a clear signal that the SEC is taking a more nuanced approach to crypto, which is a positive sign for the industry as a whole. But while regulators are opening doors, other parts of the traditional finance world are showing signs of stress that could spill over into our world. I'm talking about the developing situation with Blue Owl Capital, a major private credit fund that has halted redemptions. Esteemed economist Mohamed El-Erian has called this a canary in the coal mine moment, reminiscent of the 2007 Bear Stearns collapse that preceded the global financial crisis. BitMEX co-founder Arthur Hayes put it more bluntly, telling Fed Chair Jerome Powell to warm up the printer. A liquidity crisis in traditional markets could lead to more monetary easing, which has historically been rocket fuel for Bitcoin. This is a double-edged sword, as a broader market downturn could initially drag crypto down with it, but the subsequent policy response could be incredibly bullish for the asset class. We saw a similar scenario play out in 2020, where the initial COVID-induced crash was followed by a massive rally in crypto as central banks around the world unleashed unprecedented stimulus. Now, let's look at what the on-chain data is telling us. there's a fascinating story unfolding between the small fish and the big whales. Data from Sentiment shows that small wallets, those holding less than 0.1 Bitcoin, have increased their holdings by 2.5% since the October all-time high. These retail investors are buying the dip. However, the whales, those holding between 10 and 10,000 Bitcoin, have trimmed their positions by 0.8%. This divergence is crucial. While retail buying provides a floor for the price, we need the whales to start accumulating for a sustained rally. The shrimps are doing their part. Now they are waiting for the whales to join the party. This is a classic standoff in the crypto market, and the resolution of this divergence will likely determine the next major move. The Glassnode accumulation trend score, which has been a reliable indicator in the past, is currently at 0.68, suggesting that we are in a period of accumulation, but the lack of whale participation is a cause for concern. Let's not forget about the altcoin market, which has been a mixed bag. Ethereum, the second largest cryptocurrency, is trading around $1,976, up a modest 0.2% in the last 24 hours. However, it's facing its own set of challenges, with institutional outflows and concerns about the upcoming Shanghai-upgrade. Other altcoins such as XRP and Solana have seen some positive price action, but they are still struggling to break out of their recent ranges. The meme coin sector, led by Dogecoin, has been particularly hard hit, with Doge down 9.6% for the week. This suggests that the risk appetite in the broader crypto market is still low, and traders are flocking to the relative safety of Bitcoin. With all that in mind, let's turn to the charts. Bitcoin is currently in a corrective phase, consolidating below a critical supply zone between $69,000 and $71,500. On the daily chart, our major support level is at the $60,000 mark, with a secondary support band between $65,000 and $66,000. The price action is getting tighter, with the 1-hour chart showing a tight consolidation range. This coiling of the price is classic pre-expansion behavior. The question is, which way will it break? The moving averages are also telling a story of conflict. The short-term moving averages are providing some support, but the longer-term moving averages are acting as firm resistance. This indicates that the market is at a critical inflection point. The Bollinger Bands are also squeezing, which is another indicator of an impending volatility expansion. This brings us to our trading strategy for the next 24 hours. We have clear technical triggers to watch for. Our bull trigger is a decisive close above the $71,000 level, accompanied by a surge in volume. If we see that, it would invalidate the current corrective narrative and open the door to a move towards the $74,000 to $75,000 range. The momentum indicators, while currently neutral, are showing some underlying constructive signs, suggesting that a breakout could have legs. A breakout would signal that the bulls have taken control and that the path of least resistance is to the upside. In this scenario, I would look to enter a long position on a retest of the breakout level, with a stop loss below the breakout zone. On the other hand, our bear trigger is a loss of the $66,000 support region. If we break down below that level, it would signal that the bears are back in control and would increase the probability of a deeper retracement towards our major support at $60,000. This would be a signal to tighten stops and prepare for further downside. A breakdown would indicate that the corrective phase is not yet over and that we could see a retest of the recent lows. In this scenario, I would consider entering a short position on a retest of the breakdown level, with a stop loss above the breakdown zone. So my strategy for the next 24 hours is one of cautious optimism. I am closely watching the $69,000 to $71,000 resistance zone. I will not be chasing the price here. Instead, I will wait for a confirmed breakout or breakdown. If we get the bullish breakout, I will look to enter long positions on a retest of the breakout level. If we see the bearish breakdown, I will stand aside and wait for a better entry opportunity at lower levels. The key is to have a plan and to stick to it. As the saying goes, plan your trade and trade your plan. It's also important to manage your risk effectively. I would recommend using a position size that is appropriate for your risk tolerance and to always use a stop loss to protect your capital. In this complex and volatile market, it is crucial to have a clear plan and to stick to it. We've covered the fundamental drivers, the on-chain dynamics, and the key technical levels. Now it's up to you to use this information to make informed decisions. Thank you for joining me on Boni's Life. Trade smart, stay informed, and I'll see you in the next episode. Remember to do your own research and never invest more than you can afford to lose. The crypto market is a wild ride, but with the right knowledge and a solid strategy, you can navigate it successfully. Stay safe and happy trading.